Have you ever wondered why the rich get richer and others don't? Could it be that a small percentage of the population pay others to find, study, and execute on legal loopholes that exist with our financial life and make it easier for them to prosper? The answer is a resounding yes. This is the Secrets of the Wealthy podcast with John Mintz. John has spent a lifetime researching and mastering the financial loopholes that he believes should be available to everyone. Join us as we explore different strategies that help you get farther faster towards building and enjoying a prosperous retirement.
Hello and welcome to the Secrets of the Wealthy with John Mintz. John, how are you?
Hey, Eric. I'm really fantastic. This being Easter weekend, it's just an honor to celebrate the resurrection of our Lord and Savior. So that in and of itself is a big deal in our house. But excited also today because, the name of our show is The Secrets of the Wealthy. This being the third episode, we're finally going to get into some of that today, which is great. Yeah. So I'm looking forward to it.
Yeah, really digging in. And before we started recording, you had mentioned that you were actually teaching on this same subject last night. And I know that you are an extremely busy guy, with all the different outreach that you're doing and educational events and things that you do for both clients and prospects. Well, I know that you taught on this last night, so it's fresh in your mind. And we're talking taxes today, which is everybody's favorite subject, but incredibly important, right? I mean, especially after this last year. And I know that because of last year, 2020 and all the influx of money from the government, so on and so forth, tax increases seem to be a really growing concern for a lot of people. Would you agree with that statement?
Oh, I definitely would agree. And let me just start by saying, hey, I am not an accountant, so please don't anyone take this as accounting advice. However, to answer your question, it makes me think of that statement, the elephant in the room? Mm-hmm. Well, the elephant in the room in this case is that tax increases are a mathematical certainty. Now, don't kill the messenger for the message here, but it's real, and it's really time for all of us to start doing something about it.
Yeah, absolutely. Okay, so that leads me to my next question then. Mm-hmm. If taxes are going up, which I think most people would agree with, what can we do to plan for it?
Well, there's a lot. I guess the best way to answer that would be for me to just tell a quick story.
All right.
And it's about my oldest son. And when he was in the fourth grade, he decided that he wanted to compete in a spelling bee. And he, not knowing what I was getting myself into at the time, I told him I thought it was a great idea because he was bright and he'd be able to feed his knowledge base even further this way. And well, I greatly underestimated the number of hours that we would need to spend studying together so that he would be able to spell every single word imaginable that he could be asked in competition. He had to know the word, he had to know the definition, he had to know the origin.
Wow.
I think we probably logged close to 500 hours of study together.
Ooh. Wow.
Yeah. When I say a lot, I mean a lot. And that was, over an extended period of time. But the end of the story is that as a fourth grader, he beat every fourth, fifth, sixth, seventh, and eighth grader in his school.
Wow.
As a fourth grader. And playing a little bit to brag on him, but more importantly, he learned the value of hard work, and I expanded my vocabulary considerably in the process. So it was a win-win. But the other point here is that if you want to be good at something, like reducing your taxes, for example, then you got to put in the work. Mm-hmm. So you can either block out, 500 plus hours to start learning more about legal tax loopholes as it relates to your pre-tax accounts like IRAs and 401ks and TRS or whatever. Or you can find a knowledgeable advisor that's already done that and make him your friend and your partner, right? So it's a mathematical certainty. We just said that, right? The taxes has to rise, or the Congress has to dramatically reduce spending. Now, Eric, do you see any signs of Congress reducing spending?
No, not at all. I mean, we saw what happened last year, and I know that I think they just passed 1.9 trillion more. So that just goes right onto the national debt. So what are your thoughts on that?
Yeah. Well, it's not just the 1.9 trillion, but there is another, I think it's somewhere between 2 and 3 trillion being worked through Congress as we speak. That trillion is with a T, not an M. So And a lot of folks don't realize how big that number is. $1 trillion. 1 trillion is equal to 1,000 billions.
Yeah.
And in the class, I teach that. Maybe we'll get around to that in another show. But if you go to the website, and if you're listening to this today, and you can actually Google while we're talking here, and go to the website usdebtclock.org, usdebtclock.org, you would find the following. And a lot of folks have never seen this site, and it's running real time, showing our national debt and all the things that go into it. It's scrolling like really, really fast as it's increasing. It's interesting, but make sure you don't have something to eat before you go look at it, because it might come back up. But what it does is that is a government site telling us what our national debt is, and right now it's 28.1 trillion, but that does not include the 1.9 just added to it. So we're at 30 trillion and growing. But the more alarming thing is in the lower right-hand corner of that, it shows the average debt per citizen.
Yeah. And
it's almost $500,000. Now, I didn't say per taxpayer, per citizen, which includes man, woman, child, grandchild, newborns, and all 9 yards. So it's a real problem, and our government's blatant disregard for our debt is really starting to catch up with us.
Yeah, John, I've been to that website. It is a little scary, but it's great information to have. And I totally derailed where we were going with my question from earlier with that, with the 1.9 trillion, because it is such a shocking number. But back to what I was asking before, how do we plan for it? I mean, we know the taxes are going north. How does somebody plan for it?
Well, you mentioned earlier, I taught a class last night, and a Tuesday night also, same class. One of the questions I asked during that class is, and I asked for a show of hands, do folks think taxes are going up or down in the future? And you could probably guess how many folks raised their hand when I asked if it was going to go if they thought taxes would go down. I never ever find one person that doesn't think that taxes are going up. But then I asked the second harder question, which is, what is your plan? And they don't really have one. I tell them, you don't think you have a plan, but you do. And right now you have the government's plan. Then I ask them, do you want the government's plan or do you want your own plan? Because the government has a plan, and if you don't get one, that means you're going to be, falling prey to their plan. For example, 70% of seniors say that they know little or nothing about RMDs. Now, when I asked the class, last 2 nights when I asked the class how many of them could come to the front of the room and explain what an RMD is, that not one person raised their hand. That's 100% right, but the statistics say that 70% can't. Well, it's really simple. An RMD is a required minimum distribution, meaning that at the age of 72, if you have not started and already withdrawn money from your pre-tax accounts, then the IRS is going to start forcing it out. And they're going to force out more and more every year until you die. And so that's a government plan, right? We could either, do it that way, or we can do it a much more proactive way, obviously.
Okay, so speaking of that proactive way, what is that? What else can somebody do to plan for the taxes that are, looming?
Yeah, well, a start would be to go from a micro approach to saving taxes to a macro approach. A micro approach to taxes is like this. Hey, I want to save taxes in the current year. I'd really like to learn how to best lower my taxes this year. But a macro approach to taxes is, I want to learn how to lower my taxes over my entire lifetime. And my observation is that most folks do a great job of accumulating assets during their working years, and they might even take the time to properly diversify them. We call this asset allocation, and most folks know what that means. But I find that it's very seldom that someone has any focus at all as it relates to asset location. Not asset allocation, but asset location, meaning that you should have a taxation balance in your retirement accounts, which is just as important, if not more important, than asset allocation. So an example of that would be if you have 100% of your retirement assets in a 401k, and I've seen it, by the way. I see it often. And you think you have just enough money to retire on, and then about 3 or 4 years in retirement, taxes double.
Yeah.
Well, you got a huge problem, right? And that's not even taking into account market volatility or what else could hurt that retirement. But there are ways to reclassify the tax status on some or all of those assets from fully taxable to tax-free. And I tell folks all the time, if you're not going to be a student of the code, the tax code I'm talking about, then you better find someone that is and become good friends with them quickly, because what we have coming at us in the way of taxes is just this big old giant snowball rolling down the hill, and it's growing literally by the day.
Yeah. Yeah. And you said you better find somebody and, make them your friend quick, which I agree with. It's nice to have smarter friends than me, and most of mine are. So that's great. But when it comes to tax planning, I mean, this is something a CPA or accountant should be doing, correct?
Well, of course. But there is a difference between tax planning and tax preparing.
Okay,
So, for example, a CPA knows what a Roth IRA is, or he should, right? And can tell you the pluses and the minuses of a Roth from a tax standpoint. However, ask him or her to do a comparison of contributing $1,000 per month pre-tax for the next 25 years in a 401k versus only contributing $750 per month after tax into a tax-free Roth IRA, and then have him tell you which one would be more beneficial. That this just isn't in most accountants' wheelhouse, right? Nor do they have the tools or the time to be able to do that sort of thing. All that said, we consider ourselves partners with the client's accountant. We want to make sure that any recommendations we make as it relates to taxes are in conjunction, with their CPA, so that any recommendations we make is going to be in the client's best interest, either short-term, long-term, or both.
Got it. Yeah. And something that we haven't even spoken about is tax law changing, right? I know that there was the Secure Act and there was another one. I can't even put my finger on what that was, but things change all the time. And so with those changes happening, for me, it's impossible to keep up with. And I think that would be the same for most consumers. What is your advice as it relates to how to deal with the changes? How do we keep up with it just so we can be smarter about our money?
Well, it's log that 500 hours or find a good friend, right?
Yeah.
One, and that good friend is one that not only has spent a lot of time in the past educating themselves, but continues to do so. If I spend 15 minutes with a potential client, I can usually tell if they're going to be a good fit for me, and they can usually tell if I'm going to be a good fit for them too. It's for men, we call that our gut, and for women, I think they call it intuition, but it's right. An example of that would be, to give you a more specific example, a lot of folks don't know what a Roth is. And I don't find anybody that knows what a Roth conversion is. So in these same classes, I ask that question, for a show of hands. And I get a few people that actually have a Roth. Probably 20 to 30% of the class owns a Roth. But no one even knows what a Roth conversion is. And they're completely different and separate things. And it's a major, major secret of the wealthy, the Roth conversion is. We take time covering that, but some general Roth statistics are this. There's in excess of $8 trillion invested in IRAs. And only half of the individuals that actually have an IRA have a Roth. But here's the more glaring statistic. 9% of all IRA assets are held in a Roth. Now, another way to say that is 91% of the $8 trillion out there has never been taxed. So if you don't see that as a problem, you're just not paying attention, right?
Yeah.
So,
and the tax man cometh, right? I think that's a phrase.
Absolutely.
Yeah. What are some other tax law changes that have come about that we might not know about?
Well, you mentioned actually one of them, which is the Secure Act, and this one kind of came and went, and there wasn't. I don't think a lot of people noticed it. It happened a couple of years ago, and one of the good things that came out of that was the required minimum distribution age that I discussed earlier. That was pushed back from 70 and a half to 72, which that was a good thing. A lot of folks really liked that, but they missed the bad part, which is that same Secure Act removed and eliminated what's known as the stretch IRA. Well, to explain that in brief terms, what that means is that if me and my wife died and we had a $2 million IRA and we passed that on to our child, before there was ways that he could stretch the distribution of that out over his lifetime, which would keep him in his same tax bracket and he wouldn't have to pay excess taxes. Well, that's gone. So now he has to pull that same $2 million out in 10 years or less. Mm-hmm. So now that's $200,000 per year. And let's just say my son was making $200,000 along, combined with his wife on an annual basis. So now they're going to have $400,000 a year in income for 10 years. And what tax bracket do you think that's going to put them in?
A much higher one.
Yeah. In 1978, the tax bracket was 70%. So 1.4 million out of that 2 million is gone. They get to keep 600. I don't think most folks want that. That's what they had planned, when they built that IRA. So, yeah, we've got to be paying attention. That's for sure.
All right, so this actually brings up a great question because I just had a discussion with my daughter recently. She's brilliant, dude. I'm just going to tell you that right now. Just out of nowhere, she's 21. She's like, "Hey, Dad, should I start a Roth?" I'm like, yes, you should. I was so proud, of her doing something and being proactive, and then we led to a great discussion. But I want to ask you, at what age should someone consider doing tax efficient planning? When it really comes to their overall picture.
When they start earning a dime, I guess. But anytime from when they start to earn income up until they're about 50 years old, a lot of employers have 401ks. A lot of employers have matching. And, my order of money, as I put it, is free money is right on top. So if we have an employer that's going to give us some free money via matching, we always take that, right? But if not, then the second order of money is tax-free money. And then below that would be partially taxable and fully taxable money. So I ask folks all the time, if you don't think taxes are going down, if you think taxes are going up, does it make sense to defer taxes into the future if you know they're going to be higher? And they say no. I said, well, does it make sense to overfund your 401k because that's what you're doing? Overfund meaning put in more than what the match is. And they say, well, no, that doesn't make sense either. Well, where do I put it, John? I said, well, why don't we start a Roth? That leads into that conversation, right? So that's up until about 50. If you're already 50 and maybe all the way up till about 70, sometimes we have to focus on fixing what may be broken. Whereas folks did not take advantage of Roths all these years, and now they've got this really large IRA or 401k, and they're worried about it. And then we start focusing on Roth conversions, which is where we actually can convert money that's already in an IRA or 401k over to a tax-free Roth. Whole different way of doing things, but it can be done.
Okay, so I'm going to ask you right now. I know that the Roth conversion there's a lot to talk about there. Can we do a podcast on that in the future?
Sure.
Yeah, just straight, because I think that people want to know. They want to know what it's all about, and they want a clearer picture and kind of what the impacts can be on their life. So, and we're just running out of time for today's podcast. I don't want to run super long, but I think that would be a great topic for another one. And speaking of running low on time, if you could leave the listeners with one final thought on taxes, what would that be for today?
Well, yeah, you already said it, Eric. What we covered today is really just the tip of the iceberg, right? And for time's sake, that's all we can do. But in future episodes, I actually do plan to discuss what I like to call a financial perfect storm, which is we have these two forces that are merging together to cause a financial storm unlike anything I think we've ever seen. But more importantly, we're going to cover what we can all do to prepare for these storms and the strategies to reduce taxes and how to protect against market volatility and some really important things. And I'd like to leave folks today with one final thought. And I love this quote from Zig Ziglar. And he said, expect the best, prepare for the worst, and capitalize on what comes. And this is exactly our approach when it comes to planning. If we plan for taxes to go up considerably, prepare for the worst, right? And they do, then we have a plan to avoid the damage it could cause. If we plan for the worst and it doesn't come, then we're all in tall cotton, as the West Texas farmers like to say. But if you don't plan for the worst, and it does come, well, we all know the end of that story.
No, absolutely. It's not a good ending, is what that is. So,
No.
John, this is a great podcast. So, for the listeners out there, if they're interested and they're saying, you know what, I know a little bit about taxes. I know a little bit about Roth. I've heard of it before. I've heard, I need to be more tax efficient. I just don't know if I am. And they want to have that conversation. How do they reach out to you?
Well, they can go to our website, again, which is builtmore-financial.com. But most folks prefer to call us directly. And our main office number is 817-225-6260.
Perfect. John, I know you mentioned it earlier. We're recording on Easter weekend. Man, have a great weekend and just enjoy the family, enjoy the time.
And same to you, Eric.
Thank you. Appreciate it. And we want to thank you for listening and tuning into the Secrets of the Wealthy podcast with John Mintz. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at the Secrets of the Wealthy, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Secrets of the Wealthy podcast with John Mintz. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of John Mintz. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.